All right, hello everyone, and welcome to part two. Just wanted to do a little disclaimer. Nothing said on this or previous video should be construed as financial investment advice. We're just two dudes talking about the markets. So anyway, let's get back to it seemed like we left off on commercial real estate. And so go ahead. What shoot.
So, I mean, we all know that during the pandemic, we were forced to work from home. And now, yes, some people are coming back into the office. I don't know if you have to work in the office, but they tell us that we need to come in 3 days out of the week, but no one really comes in. So, a lot of firms, what they're saying is that, hey, look, we're gonna actually get rid of our office downtown. I have some neighbors right now, and they're completely remote because it's just cheaper to have them work remote. So if I have neighbors who, and I live in the suburbs, and their office said, "Yeah, get rid of the office," then what's going to happen to the overall economy in general? Or they have to come in once a week, so they need less space then for the office. It's going to have ramifications throughout the economy. And the way that I see it right now is like you listen to Gerald Salenti still, right?
Yeah, some.
Yeah. Yeah. So he's one of the few people keep on talking about it because people, when I talk about it, they just mock me saying, "Oh, they've been saying this for years." Yeah, they've been saying it for years because it takes time for these events to occur. And when liquidity dries out, then that's when the bubble actually pops. But he was talking about vacancy rates are pretty high throughout the nation. And you look at these big cities like Chicago, you look at New York, you look at LA, and they have higher vacancy rates compared to, you could say, places down in the South, like you could say Houston, you could look at places in Florida, and the list goes on. So this is going to be coming to fruition. And then you mentioned that what there's a couple $1 trillion in loans that will need to be repaid, and they don't have the um, individuals to make those payments because a lot of tenants are leaving. So this is a recipe for disaster. And what is also crazier is that these regional banks have huge exposure to these commercial real estate properties. And what's crazier about these banks, regional banks and big banks, is that they have a lot of their liquid cash in long-term securities, long-term bonds, and bonds have taken a huge hit. And if it's, held to maturity, there's a huge problem for these banks down the road. And I know that you look at financial statements and you know quite a bit because you're an accountant yourself. This is just one huge recipe waiting to blow up. Just looking at the banks and looking at how people can't be able to pay their real estate loans for the commercial side.
Yeah, I follow the commercial real estate. I mean, I follow almost all markets, and the only thing I think that might be able to have it put it off past 2025, I think problems will begin is you never know, they might be able to renegotiate an extension because the last thing they want is not to have to call in and say, well, this is a worthless piece of commercial real estate. No one's coming here, so all right, maybe we'll give them, a couple more years. But I think the problems will start this year. The only reason I say so hesitantly is I've seen things extend way beyond the
Yeah, I
realm of
mean, we've seen,
possibility. So, but I think problems will come this year.
yeah, I think it would be more of like early next year that's when we're probably going to see some shoes to drop. And then not only that, you're looking at the overall economy. I don't think the job markets are as rosy as they have been represented in, you know, the whole mainstream um, news outlets. And we saw a revision a couple of months ago of this, I think it was over 800,000 jobs that the Biden administration said were created, but that did not happen at all. And I just wonder post election, how many jobs are going to be revised to the downside? And then more layoffs, unfortunately, occur because of that. And I think the first step that you're seeing right now is you're seeing companies, they don't want to lay people off because of morale. And what they're doing right now is they're like, okay, you got to come into the office 4 days a week. And a lot of people are like, no, I'm not going to do that. And some firms are just expecting people to quit, which they are. And then what ends up happening is that they're not going to backfill the position, not anytime soon. So they're getting away with it now, but what happens when the macro gets a lot worse, especially when the yield curve is on inverting?
Yeah, I switched jobs a couple of years ago, and they didn't fill my position. They just divvied up the work among the manager, controller, the new controller, assistant at the time,
Yeah.
and the accounts payable and receivable heads. And so that way they figured, well, if we divide all his work among all the top people, it shouldn't be too long. But
Right,
the
right.
funny thing is, one of my companies, they gave me like a S-41 that I used to
Okay,
work for, and it was
okay.
like their whole annual statement, and most of their net income was unrealized gains.
Unrealized
And
gains.
and I
Interesting.
was like, whew, when this market turns south, a lot of companies are going to be going from accounting net incomes to an uh accounting the but speaking of the bonds, negative income. So that's why I'll share my screen, but this is the
Yeah.
TLT. And this is one reason I always say don't ever think anything stocks or Bitcoin could never go down, because you were probably there in the 2008 through 2012. Do you remember how people said treasuries could never are a safe investment and could never go down?
Yeah, I mean, they kept on saying, oh, this will keep on going up, this will keep on going up. And then the banks have that mantra, and that's why they have these, what, 10-year T bills or T bonds where they're losing a huge chunk of money
So,
because interest rates went up from when
so,
they bought it at.
so for all of you listening, I'm looking at the TLT right here. I'm going to highlight it. This is a 5-year chart, and bonds are already in a bear market. If you just look at it right here and look at it, 5 years down 34 percent. And I think some of this money is going into the stock market, but I think this is also interest rates. And the treasuries are supposed to be the ultimate safe havens. So,
So,
do you think anything like commercial real estate could do anything to this, or is it just solely interest rates?
so I do want to add a few things to this. So, bondholders, they don't really go into TLT. Yeah, I do trade it, I do speculate in it, but bondholders usually just, if they're smart enough, they go into short-term T-bills. So you put in a T-bill for 6 months, you get your money back plus interest. So those people are doing fine. It's just the long-term holders, uh, and say, you look at the chart from 2020, you see the top of TLT, what is it, like 80, close to that. I remember
Yeah.
trading it. It was like 180. So these banks, some of them were insane to buy like 10-year T-bills, T-bonds at that time. Like that was ultimately insane. If they're doing short term, that's different. But as long term duration, it was ultimately insane. And how it ties into commercial real estate, how I was saying earlier, is that these banks are invested in CRE loans. And they're on the hook if, you know, the tenants don't pay. And that's what's going on. And then there are other investments that have taken a hit. Are there is their bond portfolio if they've invested in long-term bonds close to the top? Just looking at and they have to buy bonds because of rules for collateral, rules with agencies, and all of that. But if they have long-term debt, T bonds, it's just a recipe for disaster because then on one end, commercial real estate blows up, and then their other liquid holdings also um, are not making them money. They're taking a loss. So some banks obviously will go under. And now the question will be, is this going to be a 2008 scenario where, okay, we don't know who's impacted. We don't know what's really on their books. And then it just becomes a game of hot potato. And that's why you had Hank Paulson and Neil Kashkari in 2008. They just bailed out the whole system. And,
Well,
go ahead.
go ahead.
I mean, like, I know this is a parent friendly show or children friendly show, but it's like financial herpes. You don't know who has what.
Yeah.
But so that's the problem. I mean, sure, some of the smaller banks we could probably do a smell test and be like, okay, this bank is probably safer based on certain ratios, but some other big banks, we don't know what they're invested in the derivatives market. We don't know what else they're doing off balance sheet. It's a very sticky situation, and we probably won't know until the main event the next year or two.
You know the saying, when the tide goes in, then you get to see you swimming naked.
Exactly.
I forget who said that. I think it's Buffett.
Maybe. Yeah, I
But
think it is.
and this thing about this is I follow this, and this almost was bailed out through the 2021 money printing, but interest rates, it's not just commercial real estates. Like Avi writes, these Truist Bank, what's going to be their problem is the auto loans. They have so much exposure to auto loans and credit card debt. People need this to survive. So it's just, and interest rates on credit cards are 25 to 28% now for a lot of
Just
people.
imagine if credit cards get shut off during that time.
Oh yeah.
Yeah, that's another recipe for a disaster
Oh
for
yeah.
millions.
And then when it comes to housing, like I personally think there's a residential real estate bubble, but I think one of these is going to pop first, and then someone's going to have to sell their home to raise cash. Sort of like a real life margin call instead of a financial margin call
Who's going to
coming
buy at the
through.
time? Who's going to have the cash? That's the thing.
Yeah.
Not many will.
Oh yeah. So yeah, there's a lot of different definitely bubbles out there. And we talked about the commercial real estate, I would say. Would you agree that's probably the first domino to fall?
Yeah, and then what's next?
Yeah. I can't guarantee that it's going to be the first. Obviously, I can't guarantee anything, but it looks like because we know there's some due this year. I'm not sure exactly. Have you ever seen this happen? I actually have almost no debt. I just have my car loan. And I keep getting ads from banks about personal loans with lower interest rate.
Yeah, I
And
get that all the time.
yeah, I get that. So I personally think with credit card debt, that might be the last because they can extend and pretend with the personal loan. Uh,
Yeah, they just consolidate it or whatever they do.
yeah, but commercial real estate, those are big, massive conglomerates. They can't consolidate that. So let's go into I guess the last topic. We'll go into gold. Unless
Yeah.
there was well, we'll do a little bit of sports cards because that's also AIA sports. But gold, well, I think this year it will go up
Hmm.
and I think it will break 3,000. And then after that, all bets are off. But one thing I like about and why I don't think anyone should ever be fully out of gold, I think at the lowest they should have, in my opinion, I'm not telling you what to do, but 10%. But for the main reasons is it's always going to have value. And I can go on Avi's bank list. I can go do my own research. But the reality is, none of us know which banks are going to
Right.
survive and which aren't. And no matter what, you know your gold is going to be there. You know it's going to have value, even if it comes down. So, what do you think? How do you think it's going to do this year? And where do you see it going?
Where do I see gold going? I've seen targets like you mentioned for 3,400.
Mhm.
It'll top out around there. Initially, I saw 3,000, but then I've seen multiple analysts using different metrics saying about 3,400. And what will probably do better in this run up in the next year or so, I think is going to be silver. And silver is the poor man's gold. So, like with Bitcoin, you have MicroStrategy and then you have Coinbase. So, Coinbase is like the poor man's MicroStrategy. And silver has these crazy run-ups. So, I don't think you were alive during the Hunt Brothers thing.
Nah.
No, okay. I wasn't either. But you had the crazy run-up during that Hunt Brothers time. And then you had the crazy run-up with
Can I
Mac.
pause this real quick?
Yeah,
All right, I think someone's at the door. I'm going to pause the recording real
yeah,
quick.
sure. Ready?
Yeah, sorry. Yeah, sorry. Go ahead.
So I was talking about silver being the poor man's gold, and we saw Max Kaiser. Max Kaiser was like pumping it up to the moon back in 2011, 2010, 2011. And I think that we could have a similar situation where silver does get pumped up. Nothing like Bitcoin or anything like that. But you could see miners go crazy at that time frame because miners have gone nowhere the past decade. And I don't know your thoughts on this. I've interviewed Roy Byrne about miners, but a lot of these miners have not done well because of the ETFs. And some of these paper ETFs, I don't even know if they have the gold that they say that they do. And if those like paper ETFs go bankrupt or whatever, I think that could be a catalyst for miners going higher. But I just don't know when those, the GLDs and the SLVs, when their time's up. It could just be a nothing burger, but that's just the thought in my mind. There has to be a catalyst for these miners to go higher. And that could be it if it does end up happening relatively soon.
I think it's a combination of things. I don't think it's like one thing. And like I did a video and I realized I kept hearing like Bitcoin, that's taking away money, products like gold ETFs and leveraged options.
Yeah.
And I heard, what was the other one? The stock market. And then I realized, I was like, wait a minute, the royalty in streaming
Yeah.
is doing really well. And I was like, why didn't it take money away from those? But then if you look at the royalty and streaming business, one thing they generate is consistent positive. Well, some say free cash flow, but Wall Street is more earnings type, but a
Yeah.
consistent positive net income, and they have positive and high retained earnings. So I think
Right.
a lot of
Right.
these miners with the all-in sustaining cost, especially from 2021 to 2023,
Yeah.
and I think one thing that will generate the miners to go is if you look at the all-in sustaining cost from, even though it doesn't feel like a bull market,
Yes.
I actually would get mad when technical people be like, this bull market began in 2015. But 2019, the price was at 1100. So it was like, to me, it went flat and then it went all the way up in 2020 to like 2000 again. And the miners started going up. But then with inflation, the all-in sustaining cost went up drastically. But
Yeah.
from 2021 to 2023, gold went from 2000 to 1600. So they really got crunched. And even though gold started going up to 2000,
Hmm.
the miners didn't start going up until March. In October 2023, that was sort of the bottom of gold. It started going up to
Yeah.
2000. But the miners didn't go up until March. And I think part of that is they started making positive net incomes in the last quarter. And that wasn't seen until the first quarter
Hmm.
of March in 2020. And then with gold being up, and so now they're able to make positive net incomes for making consecutive quarters. I think that, and I don't think there's gold in GLD. I remember, I don't know if I told this story, but when I first started investing in 2009, I bought the SLV.
Yeah.
And the first thing they did was they gave me this huge packet of legal liabilities and how they're not liable for all this. And it literally, I should have taken a picture,
Yeah.
but I didn't know I'd be doing any type of YouTube. And in the prospectus, it was like saying, or whatever it's called, that this isn't silver. There's no silver involved. And and I sold it immediately because I was like, this sounds fishy. I thought this was like silver, and they had shares for each silver that they had. And then I went by to buy real physical, and then that's like anyone who's bought real physical, at least at the time, that was like the Wild Wild West. They would
Right. Right.
sell you fake numismatics, fake. That's
Yeah.
one reason I will never say anything bad about Peter Schiff is he exposed that whole
Yeah.
shady practice.
Yeah. He taught me about that. Yeah.
And he also exposed, and there was so much pump and dumping going on with these mining stocks where they would have these fancy report and they would give you crap stocks. They would go up as soon as they put them in email.
Oh
And
yeah,
then
I
three
remember
days
that
later,
agency. Yeah. I remember
they would
those.
crash. So Peter Schiff has saved a lot of people from falling into scams. So just
People
that
now are
alone.
bashing. So here's a contrary indicator for gold and silver. Everyone is bashing Peter Schiff over Bitcoin. And I see it all the time. And I'm thinking, okay, this must be a better time to be buying, especially miners. This is my opinion. I'm not telling you what to do. The audience. If they're
Mhm.
bashing him like crazy, I like taking the other side of the trade. I want to do maybe what Peter's doing right now. I mean, not all my money, but maybe a little bit. And, maybe take some of that Bitcoin profits and put it there. I don't know.
Yeah, so I'm I've basically become I consider myself a mining expert per se because I've invested in it for so long and I've been able to grossly just outperform one of my
Good.
in those sector just because I've basically memorized all the drill hole results, looking at production and everything. And I think I do think that's a contrarian and just not many people want to go in. And you're starting to see some miners do
Yeah,
well. I think the juniors will.
they're gonna pick
I,
up, in my opinion.
yeah, I think they're going to start picking up because a lot of these companies will want to start growing again.
Yep.
So I guess let's go to the last topic is sports cards. What do you expect for those? I still have my four cards. Four hockey cards and my Katie Ledecky pack, which that was just a lottery ticket to Katie Ledecky.
Yeah, I have a few of those lottery. I did have those lottery tickets at the time, but I mean, just going to macro. Remember that M2 money supply chart? Maybe I should show that again.
Sure.
Yeah, just so people can actually visualize it. M2 money supply, St. Louis Fed. I can't believe I'm looking at like M2 money supply and looking at the Federal Reserve and sports cards. But anyways, yeah. So let me look at it from a 5 year time frame. You see, in COVID, M2, February of 2020, you see 15 trillion, and this went to like you could say closer to the top, 19 trillion. That was a huge increase in money supply. I think like month over month it was going like 20 trillion. I mean not 20 trillion. I mean it was going up 20% a month. That was insane. And now we've have a normalized increase in money supply. So sports cars, they'll continue to go up like the high end, but it's not going to be like it was from 2020 or 2019 to March of 2021. And yeah, there was hanky panky, as I say in my videos. Yeah, there's a lot of shady things going on, but still prices still go up when you see money supply going up. But we don't have money supply going up. So yeah, you're going to have some cards go up, but you have to be very selective. And a lot of people cheat the system, so I'm not a fan of investing in sports cards anymore. I used to be um, talking about investing, but I don't see that advantage anymore because I don't want to cut corners. A lot of people will and have, but that's just not me. I don't operate that way. If that makes sense.
Well, definitely. So yeah, I bought some sports cars early, pandemic, and part of them were just Hall of Famers, and
There you
I don't
go.
plan on selling them anytime soon. They're more collectors
Yeah, this is like
for
collector's items. I mean, like this is what is it called? I you can't even see it, but I have a Cal Ripken 263032. And it's just like a couple dollar card. So I'm just doing it to collect now. It's not really, oh, I want to speculate. Maybe I might buy some die cards of Michael Jordan and sell it 10 years from now and buy a bunch of them.
Mhm.
I think I'll see some appreciation, but I don't know.
Yeah, so yeah, I just have I mean, as you go with my shirt capitals, I have the Ovechkin cards.
Nice. Yeah,
They'll
I sold
be
one of them.
yeah, and they're still up from when we got them. So
You got it $100 in May of 2020.
and he's injured right now, but he was on pace to break Gretzky's record this year. I think he's going to break the record.
Right.
But oh, I think he's going to break the record. So anyway, that's all I was going to say. The time we have like 8 minutes to left. We could probably talk. We could talk about this all day. We literally have when
Yeah,
we
for
visited each
sure.
other's our house. So, but anyway, if you want to find out more. if you want to find out, are you on share? Just I can
Am
see
I?
your.
Oh, you could still see it. Oh, stop share. I'm sorry.
Yeah, I can still see just in
But
case. All right, cool. I didn't
oh,
know if you
I didn't
wanted people
realize that.
looking at your info. I wasn't saying anything. I was like, well, just in case. But anyway,
Yeah.
tell people how they can find out more about you. So,
Yeah, I mean, they can find out. They could go to AIH Sports on YouTube or AIH Finance, where I do finance videos. I get more intense on my AIH Sports videos, so if you just want to hear me, not get intense, listen to my AIH Finance videos. But I still like talking about all these things. So, yeah.
great. And all right, we'll end it here. So.